Thank you for that, Stuart, for a presentation, much of which I would agree. It's hard to disagree with any of it. And what I would like to do is really to talk about what have been some of the design flaws associated with monetary union so far, and what concrete policy steps could actually be taken to reduce the instability, to reduce the factors which have led to an amplified boom-bust cycle, and to, in a sense, complete the project in a way that would be progressive and would not necessarily impinge upon national sovereignty, perhaps. Monetary policy is not by itself a sufficient policy tool. That's become increasingly recognised by bodies such as the IMF over the last few years. We have found, or at least through empirical analysis, it has been realised that monetary policy is not enough. But even more significant than that are the increasingly apparent fragilities associated with Eurozone itself. And particularly there's the one-size-fits-all interest rate policy, which is at best suitable for 1 out of the 17 countries. This leads to a misallocation of resources within the euro area, and it leads to an application of the boom-bust cycle for countries for which the interest rate is far from the value actually set. Arguably more important than that is the absence of a guaranteed lender of last resort. What this does is it turns liquidity crises into solvency crises. If a country is perceived by the markets as being slightly more of a risk than other countries within the euro area, well then investors will move their money and move their investment and bond purchases out of that country to what are perceived as the safer countries. And this creates a cascade effect, a negative feedback loop, where countries literally run out of money because they no longer have the ability to print in their own currency, and this ultimately leads to spiraling interest rates and eventually the necessity of official lending assistance. So to go back again to the issue of the single interest rate, we can see, and Michael Burke talked about it earlier today, the fact that in terms of the fiscal balance, Spain and Ireland actually ran fiscal balances from 2000 to 2007, but in fact you can see in terms of the current account balance, it's the 4 countries that are in most difficulty, and you can see Italy in 5th and France in 6th, that are actually currently in difficulty, and this highlights the incoherence of the single interest rate policy. So what have we actually learned? What are the clear design failures that need to be fixed? What were we lacking? Well, we were lacking an EU-wide mechanism and set of protocols and conditions for writing down debt where necessary. We were lacking an EU-wide special resolution regime for dealing with insolvent financial institutions. We were lacking an EU-wide counter-cyclical support mechanism that would enable countries which are no longer able to engage in expansionary fiscal policy themselves, because as they are considered to be weak, as they fall into recession, they're considered to be more of a risk than other countries. So the bond markets are no longer interested in lending to those countries, hence the spiraling interest rates. So you create what's known as a bad equilibrium or a negative feedback loop. So at the EU level, or certainly at the euro area level, there has to be counter-cyclical support mechanisms at that level. It cannot be at the national level. And what we've also learned is that monetary union requires centralised banking regulation with an increased set of indicators, which includes price inflation, changes in asset prices, and so on and so forth, and a system of peer review so that a centralised institution is able to check on what the national regulators are doing to report back and to generate an early warning mechanism. In terms of Ireland, of course, Ireland made its own catastrophic errors. It incentivised investment in non-productive assets at a time when we should have been building up a larger sovereign wealth fund and running fiscal surpluses to dampen activity in the first half of the last decade. we instead decided to throw fuel on the fire, and we awarded a series of tax expenditures which incentivized the investment in non-productive assets such as houses, hotels, and so on and so forth, leading to massive capital misallocation within the Irish market. And I don't need to linger on the lack of evidence-based policy making, lack of strategic planning, institutional failure, groupthink, lack of accountability, transparency, and a general dysfunction within the Irish establishment. So how has Europe responded? Well, it responded by immediately creating new fiscal oversight and supervisory mechanisms. This was the European semester, the introduction of fiscal councils, which we've just seen in Ireland. They've just produced their first report. New mechanisms to fund loan facilities. This was the EFSF and the ESM, two very flawed institutions as currently constituted. The extension of loan facilities to member states, which was initially at punitive interest rates. The idea being that you would disencourage countries from wanting to enter a program. If you set the interest rate too low, they would all apparently jump to get into it. And then the conditionality of severe austerity policies. So the countries that were in recession and couldn't access the markets were to be required to ramp up their austerity policies and to do what Andy described as a Latvia. You would simply sweat it out. You would accept that your national output was going to crash. You would accept that you were going to move to high levels of unemployment and eventually structural long-term unemployment. But that was your fault. You didn't play by the rules. And of course, so infamously, at least in Ireland, there was the ECB doctrine, which was the prohibition on private sector bail-in and the socialisation of private losses. So, is the debt actually sustainable? Well, Greece is almost certainly insolvent, and it will have to restructure its debt. This is almost certainly an inevitability, and therefore the prudent thing for our European leaders to do and for Irish policymakers to do is to simply prepare for this event. And it's better to do it earlier, because the longer we procrastinate, the longer recovery will be delayed. What about Ireland? Well, Ireland's debt to GNP ratio, and we're always told that we should use GNP instead of GDP, will exceed 140% by 2013. By comparison, Greece will be close to 160%. Can we grow out of it? Well, we have a lot of recent evidence regarding debt overhangs, which perhaps haven't been included in some of the more recent models of Ireland's growth potential. In particularly, what the evidence seems to show is that if your sovereign debt levels are above 85% of GDP, if your corporate debt levels exceed a threshold of 90%, and if your household debt levels exceed 85%, well, each of these sources will impair your short, medium, and long-term growth potential. And Ireland exceeds the threshold for all three types of indebtedness. The most damaging of the three is household debt, and we all know where we stand on that at the moment in Ireland. So what can Ireland actually do within the strictures that have been imposed? Well, we could look at the promissory notes. These are the promissory notes that were given to fill the hole in Anglo-Irish Bank. If we assume a 4.7% interest rate on Irish borrowings post-2014, and assuming we are borrowing in each of those years, the annual cost will peak at 5.4 billion for Anglo-Irish Bank, which is, Tom Healy mentioned, the national school system. That's the national school system paid for 2 years in 2023 alone. The breakdown, 47.9 billion in the repayments, which we all know about, but an additional 37 to 38 billion in estimated interest rate payments. You can see the numbers there. At the bottom right-hand corner, you have a figure of 85.7 billion, which is approximately half of current GDP, just to pay for a broken bank. So why the promissory notes? Well, it's one thing to recapitalise banks such as AIB and Bank of Ireland that may have a viable future, but it is ultimately madness to continue to pay 3 billion a year for a dead bank for which we receive nothing at all. There is no chance that this bank will ever do anything constructive in the economy or provide lending to SMEs or whatever it might be. The promissory notes are also not contained within the Memorandum of Understanding, so our continued funding by the Troika is not affected. Anglo is to a large extent attached to the European banking system, and the issue of contagion is limited, and it's easier to negotiate as there's only official actors involved. There's no potential credit event here. Now, 3 minutes? 2, okay. Almost there. So what should Europe be doing? Europe should be preparing for the inevitable Greek restructuring by ensuring that the solvency of the European banking system is maintained. And it will have to do this through a program of large-scale recapitalisation, and this is what's happening in the background at the moment. You hear about the leveraging of the EFSF and the increasing of funds available to it. Of course, austerity within Greece will need to be balanced with a permanent counter-cyclical mechanism, a European wealth fund in the long term funded through the implication of a financial transaction tax, more flexible monetary policy to reflect the requirements of growth rather than just price stability, and indeed reduced contributions to EIB projects from the individual member state. There also has to be a dealing with the lender of last resort problem, and Stuart has dealt with that issue through the idea of common debt issuance. How big should the Greek haircut be? Estimates vary from between 35 to 60%. Will debts be forgiven? Will they be forgotten? The evidence, again, indicates that they will not, and that Greece will remain dependent on official funding post-restructuring. A 60% write-down would translate to approximately 450 basis point increase in lending costs for the Greek economy for the foreseeable future. So finally, what can Ireland do? What should Ireland be doing? What should our Irish policymakers be doing? And what we should be doing is we should be negotiating in the background with the European Central Bank, with the EFSF and with European leaders,